Welcome back to Be Great Economics. This is Nate. Let's get started. So we're going to go through our weekly update. It has been 2 weeks since the last one, but the last one I reviewed was fire, much like my 10th grade mixtape. So if you'd like more, just continue to follow. If you want more bad jokes, they will be here, and if you can't stand them, I'm sorry, they won't stop. I can't do anything about it. So overall, the S&P 500 has been on a downtrend. And we're breaking down below the January wick low. We're breaking down towards the February wick low. And so I just want to point out that overall, the only bullish thing here, because even the volume is moving up into the selling, which means that people are still bearish, we are seeing a positively divergent RSI, but that can fall apart very quickly, and so I don't take it very seriously until I see something else that tells me that we're going to see a positive move on the S&P 500. I would not necessarily be short from here unless you already had an entered position closer to the resistance up above, but otherwise, I'm just sitting neutral on this one because I don't see a clear play ahead at this point in time unless you already have a short position. So because we are rather descended to the downside, I would expect to break out of this downtrend eventually in the next few weeks if we don't see something very serious push it down further. In the NASDAQ, I'm going to point out that the distribution played out. We've gone down into a few short-term and cumulative ranges, but then continue to wick down, and we're seeing the same trend, positive divergent RSI, but otherwise all negative momentum and action. And so I just don't have anything to point out here other than pricing targets. We may be headed down to 12,170. I still think that that's probably the zone where we may see a stop. And if we're going to see a rally come from here, it's probably here. But let's go to the NASDAQ price in the S&P 500. And if you look at the daily down in the lower right corner, you see that we broke down, bounced off of the support, flipped it to resistance, and rejected. So breakout, retest, resume. Very negative action here right now. And so all we have left for the melt-up thesis is ultimately, as far as TA goes, is ultimately staying inside of this blue box. Because if we can stay generally inside of this range, we could possibly, which means they can both still sell off. It just means that this is the NASDAQ price of the S&P 500. It's the NASDAQ's performance of the S&P 500, tech versus regular stocks or the general stock market. We could still see it hold its general position while they decline a little more and then get the rebound and then move from there. But that we are kind of holding on to that last thread for the hopes for the melt up. I'm not going to necessarily call it dead just yet. I wouldn't be betting on it until you see, again, that signal for reversal. And so let's look at 10-year bonds. And this is what I ultimately want to get at is following liquidity flows and what is happening. The 10-year bond yield is rising over the long term. But we stopped this uptrend as people became a little fearful. Now, this wasn't exactly a drastic sell-off. We didn't even come down and retest the support yet. And so quite frankly, the inflation is really pushing the bonds up much higher, and there's still a lot of fear in the market long term, as well as the requirement for banks to hold bonds. And so since they are both required and rewarded for holding bonds by selling to the Federal Reserve, the bond purchases are continuing, but the market is still very fearful, as we can see with the 2-year running up and the 2 and 10s division as in it has inverted. So the bond yield curve has inverted again, or is almost about to invert. We're at 1.149 and we just have to hit 1 to invert. And every recession has been preceded by an inversion of the bond yield. So if we revert, we will be going into a recession is what it's telling you, and it's been right every single time. So we want to be concerned about if this happens because we have so much riding on the taper and the tapering of bond purchasing, the raising of rates, the narrative that started a while ago, while we're into a point where Americans don't have much consumer cash left to spend or excess cash to spend. They are facing a lot of inflation. Their jobs are not paying them enough more. They're getting 4.9% pay increases while real cost of living is greater than 15% up. And so we are just constantly seeing this expansion of cost while a decrease in the money supply as far as it goes to retail, who is the main purchaser of goods, the entire reason for the economy. So we are going to possibly see a recession if we continue on this path. But the Federal Reserve doesn't want to let up because it would cause people to second guess them. Now they've been given a great out. They've been given a war, and that is a historically excellent reason to not lower rates. But the problem is this war is leading to more inflation, and so they are yet again in a rock and a hard place here. And so we just want to look at what some of the concerns are. We're seeing deflationary pressures start to come into the dollar, even though the price of all goods is going up. And this is again that rock and the hard place. The dollar is going up in terms of everyone wanting it. I covered previously how the British dollar, or sorry, the British pound. Sorry, the British pound was on an uptrend as the European yields started to rise, and so the demand for pound sterling went up. However, guess what happened? It went down again, and it's going down because of the conflict in Europe that's causing downward pressure on other currencies and upward pressure on demand for the dollar. Because even though this current event of sanctions and limitations on Russia and therefore its allies, as well as effectively damaging the US's economy, is really harming the dollar long term, because these sanctions are setting the precedence of I need to get out of the dollar. We need a tertiary way of getting around these currency trades. And so the ruble has collapsed very massively, around 50% in purchasing power. It's not necessarily in day-to-day purchasing, because that the actual consumer prices of things is still generally going up. But in Russia, there's a difference between what is going on in their own home economy versus just their currency exchange. But Russia's also possibly putting a nail in the coffin on their own currency by offering the ruble instead of dollar-denominated assets. So if you thought you were going to get paid a dividend in dollars, you will now get paid in rubles. And so that will just cause further velocity of the ruble. And the only way to really strengthen it at this point, because they've raised their rates to 20% in order to incentivize bond purchasing, is probably to go to some type of commodity-based currency, which is a very strange way. Now, I don't think most of these central banks would allow that, because this would take away a lot of their capability to make their own decisions about currency and the way in which they fund their government. So more than likely, I think Russia's move will probably involve some other type of foreign swap that will get approved, purchasing euros through other countries like China, and they'll fund themselves some other way. But overall, they have enough commodities to give themselves a safety structure as a central bank versus their private companies that are struggling to do some of these swaps due to sanctions. And so I just want to talk about the federal funds rate here. As we raise rates in the United States, we have historically seen, one, we can't raise the rates as high as we used to every single time. We're on a downtrend. Demographics is a huge contributor to this, as the entire U.S. both struggles to grow its own population and its people feel poorer and poorer. There is more fear in the market every time, and so it can't handle leverage as it's taken on more and more debt in an environment that is just constantly deflationary. So we are seeing that the price of debt is essentially not able to go as high before, and we've been floored down at 0.025%. Historically, we go up in the federal funds rate in order to try to reduce a bubble and reduce inflation. And what happens is that the money flows out of bonds and it goes into the market, which just sends the bubble further. And then it hits a peak where it can't handle it. We flatline the federal funds rate, the market starts to crash, and then we drop yields again, and we go right back to square one. So we're probably going to see the same game play out. We will probably see the Federal Reserve attempt to raise rates. And I think that the chances have been constantly debated lower, and I'm not going to put a sign on the board with my theses on how the Federal Reserve is going to act next, but I think that there's a high probability that they do attempt to raise rates, because real rates have risen above 0.25%, so they could get away with it with very minimal overall impact. But we will see, because if they push the system too far, when there's a constant risk of conflict and a lack of supply and consumer spending down and consumer credit spending up, we are just seeing the perfect storm brewing here for a liquidity crisis again. But it could be very strange as we experience high inflation of asset price or high inflation of commodities at the same time experiencing deflation of asset prices. And this could get very painful very quickly. So let's cover oil. This, I think, was the worst call I had so far, where I thought we would get a retest down one more time down and then go up. I didn't necessarily have a high conviction on going down, but I did point out that that zone should have been retested. Obviously, the current events have pushed us the past 2 weeks to really run hard. And so this, I think, as I check derivative data, is showing that we are most definitely responding mostly to the futures market, and I don't know how strong this conviction is. So these markets have been bid up a little bit with too much leverage. But overall, this has been a long-term trend. I know this is a point of controversy because people will say, "Oh, well, it's the oil industry. Oh, well, it's the gas companies." Okay, cool. Follow along with the actual data and the information in front of you, and you can find that just because they're making record profits doesn't mean that they're scalping everybody. These prices are coming from refiners bidding up the price of oil in order to receive it. And so we're seeing that the futures market's high gap in the open interest is clearly positive by a massive margin. And so the obvious issue here is a fear of a shortage. Now, whether or not that shortage or the ability to get it at a cheaper price later, that whether or not that is valid remains to be seen. And we usually see pullbacks here, but I'm not going to use an indicator to try to tell me this because, quite frankly, commodities have the problem of a real shortage in supply change. And so if we do see, since the #2 producer of oil in the world is currently sanctioned, if we start cutting them off from being able to provide oil, there will be a massive demand and supply gap. Overall on uranium, I would say I'm still long bullish overall. I still have positions that I started. I said stay out of the trade here where there's this wick up when Kazakhstan was having rebellions, and then I started buying down here. I got this breakout, bought into here. We came back and then broke out again, so bought here again. We are basically seeing a successful retest and resumption of the same red box here, and so around, what was that, 22.10 or so. So I would say that we are probably going to go back up towards all-time highs. I would expect much higher in the long term. I'm still expecting around $60 on the global uranium ETF, and that especially I would expect a growth in explorers as the narrative has flipped on the green side to realize that they do need uranium, they do need nuclear power in order to keep the lights on. When we talk about copper, first off, my 1,000 to million trade, doing great. Cool. I hope that I hit my $6 target or sooner, or we don't even have to hit that as long as I make the 100% return. I'll cut it off. But I want to talk about how the whole world is a short squeeze. Nickel is a great example of this, where a Chinese bank company was short a very massive position in nickel, and they failed to make their margin call payments on time, and so it caused basically a short squeeze and failure to deliver on these short contracts. And so the London Metals Exchange basically changed the rules to allow the shorts to not have to settle in physical metal. What does this all mean? It means that they don't have the metal they're short. This is naked shorting. 101, this is the GameStop theory squeeze showing on paper that company, that the LME cannot meet the demand and expectations, and this is a reality of what is going on, is that we have paper contracts on top of real physical products. The whole world is a short squeeze because the dollar is mispriced. And so the dollar is going to discover its pricing through a lot of pain. And so nickel was the first huge sweep in this, and I'm expecting commodities to continue on this general trend. We're going to see weird rally spikes like this. I don't think that this 149% move is necessarily going to set the trend, but there will be uptrends in these commodities as people realize they need to be in these spaces, because the purchasing power of the dollar is immensely lower than they understand based off of its current market demand and supply and its long-term expectations. So overall, I'm still bullish on copper, but I want to talk about Dr. Copper. Dr. Copper is the term given for how Dr. Copper, it has a PhD in economics, can sniff out deflation and inflation, and we are seeing it spike rather harshly, and we also see trading getting halted and a lot coming out over the past few days on sanctions. And so copper not rallying further at this point in time does have me worried. Is there an impetus for deflation coming? And so I am going to put my stop loss here because I don't want to see myself get wiped from this point, because there may be a deflationary run coming. And that is, again, because of the overall macro environment causing the opportunity for a dollar deflationary crisis, a banking crisis of some type. And we have a history for this where we would see the bull market rally begin, deflation hit, crash it down, and then it comes roaring back, which is actually just a great opportunity if you're willing to hold through the volatility. Let's go to gold. We see this breakout where we're heading out into all-time highs again. The momentum is extremely overbought. However, we can go a little further, and if there is external events, we could push even further than that, like such as sanctioning Russia's gold, so that Russia has to buy and sell gold from outside of the regular exchanges because they were banned from the London Metals Exchange today, which means that there is one less purchaser and provider there. We may start to see a shortage in gold, but we will see how that plays out overall. For now, I would expect some type of consolidation near these all-time highs, possibly coming back down. I still think 1916 is in play in this range, so it could be a little while longer while we wait for gold, but it has a long history of surprising everyone in the end. So silver, I'm very happy with how this Wyckoff accumulation has played out. It's ran a little faster, which is great because my final long positions were placed in February. So far, so good. I think we are entering phase E at this point in time. We'll probably see some consolidation, which again, probably follow with gold. Now, the only thing that I think is going to stop us from reaching $28 to $30 in this next move is going to be that deflationary impetus that could come into the markets. Anything other than that, I'm not concerned, because even if we bring down a lot of the tension talk, a lot of the fear in the markets at this point in time, it doesn't really matter. We're still in an inflationary short-term trade. You could see a lot of positive growth go back into tech and the fear trade come out of this, and it would still come back down to somewhere around 25, retest, and then resume in a nice lazy pattern. But if we continue in the fear trade, we'll probably see a short-term correction and then start running again really hard. And that, to me, is going to be the healthiest way to move. Correct, 2 steps forward, 1 step back, 2 steps forward, 1 step back. Try not to just take an all-out sprint for a 100-meter dash. We want this marathon to be won overall. Platinum. So I talked about that, commodity bull market followed by a deflationary pressure and then running back up again due to monetary demand and inflationary pressures again. It happened back here, 2008, 2009, 2010, right? Down, up, or up, down, up. And so if that happens, it could push us down. But overall, I just wanted to lay out the platinum trend as I've seen it. So far, we have a Fibonacci sequence laid over it. We show that we clearly have some responses of the market to platinum for the way in which it responds to these dollar areas of resistance and support. And so I just want to highlight that what I am doing with my PLG play is I am using a fib retracement and just moving it up from there. That's it. I'm going to use the platinum as the targets, and I'm just going to use that to sell from there. Now we see the smaller target, the smaller box in here is palladium. It's already above all-time highs. Do I expect that to happen with platinum? Possibly. I think, again, the whole world is short squeeze, right? I don't think there's a lot of people very short on platinum and palladium because it doesn't really, for such small use metal, it's not a high industry demand use. Like the biggest consumption of it has mostly to do with catalytic converters for I think platinum's for diesel and palladium's for cars. Might be the other way. I can't remember the science behind that exactly, but it has to do with converting carbon monoxide into carbon dioxide so that this way it creates less total carbon output and it's less lethal when it goes to the catalytic converter. So the big thing is that it's still necessary as we still use ICE engines. The demand for it is still going to be high over the next few years as we continue to use it, and it's still used in electric vehicles and a lot of computer components. But the bigger driving factor here is that what we're seeing right now in the shorter term, other than just inflation and the fact that platinum, quite frankly, is extremely undervalued, probably less valued than silver by comparison to its historic trend. The other thing we're seeing is that the #1 producer of platinum is Russia, and so if they're sanctioned, we're going to see a squeeze on platinum and palladium availability. So we should see generally an uptrend continue. I would just be cautious with how far it could go because we really don't know. It is a very small, I think it's about, if you put all the platinum in the world in one place, it'd be about the size of a 3-bedroom house. You're talking a small enough area that you could personally own it all. and not be worried about defending it. So it's just there is a possibility that we have a very high demand and low supply trend here, along with the inflationary pressures that we've been seeing. So overall, I would still bet bullish on platinum and even palladium, even though it may be a little overextended in the longer term. Bitcoin, covering Bitcoin, I've said I've been neutral throughout this space. Getting above 40,000 and staying above it would give me a little more confidence overall. I would say staying above 45, but we are still seeing the tech correlation play out. But I am glad to see that we are getting a few days where we kind of break that correlation. We're seeing that even though you can see the trend with the positively divergent RSI, but otherwise the negative impetus is still upon us here. This may be building towards a little bit of a deflationary event. And if we're talking about smart money, let's talk about who's buying and who's selling. Long-term holders are still in an uptrend. So we know that the illiquid supply is increasing, but the available Bitcoin is going away. But whales are selling to an extent, not very massively, but some are, and we're seeing a downtrend. We saw a spike up from January into February, and then we're seeing a spike back down a little bit. And what I think that may be indicative of is that long-term holders have conviction, right? We're talking about the zealots that truly believe in Bitcoin, which is totally reasonable in terms of their moral predilection to wanting to have Bitcoin as a long-term hold, voting with their currency for a better system if that's what they see it as. But the whales may be seen as smart money, somebody who's been studying markets for a long time, who has put in either a lot of money or has made a lot of money on this and has learned how to manage it. And so if whales are selling, they could potentially be sniffing out the risk of a deflationary pressure as they expect Bitcoin to possibly plummet. That doesn't necessarily mean, I still think that there's a benevolent whale theory and that whales ultimately have to distribute to people, and so they help the liquidity go up and they move the price up and they expand its usage. At the same time, they'll send it to the downside to an extent. They'll try to take advantage of it. And so what I think will probably end up occurring is we could go, if we do get a deflationary pressure, we could go down to the 20,000 range. Now, that would be a pretty strong plummet, and I think that that would honestly be a very healthy retest. If we get a short-term deflationary pressure due to some type of market downside, but we all know how debt is managed in this modern economy. We will print money to fix the problem, and so it will sniff that out again, and I think with pretty reasonable conviction that that would be the good play here. So buying spot here, I'm not against it, but I'm not in leveraged. We'll continue to see it chop sideways, but until I see some reason to see conviction to the upside or downside, I'm not going to take a specific leveraged play anywhere. So thanks for watching. I hope that makes sense. If you have any questions, leave comments down below. You can also follow me on Twitter. This has been great, guys. I enjoy doing this on a weekly basis. I'm sorry I was not available last week. I was in a lot of training where I could not have my phone, or I was in low service environments, so I could not do this. But I've really enjoyed being able to make these products, both for my own reference and for the few people that I do have watching. Thank you. And if you have questions, again, I love learning. I love teaching. If you have news or information you want to share with me, let me know. You can share on Facebook and Twitter. Have a great day.